Welcome to the Contango Income Generator Quarterly Investor Call. I'm Marty Switzer, CEO of Contango Asset Management. In today's session, we'll give you an update on markets, how we see the world, how we're investing in CIE, and most importantly, provide you with an opportunity to ask any question you want about your investment, I should say. Joining me today is the man who steers the ship at CIE, Portfolio Manager Shawn Burns. Welcome, Burnsy.
Hi, Marty. How are you?
Very well, mate. So, Burnsy, before we go over to some investor questions, and we've got a few this morning, keen to get your view on the world right now. So the Fed surprised no one last night by increasing interest rates in the US. The local and global economy is performing strongly at the moment. Global markets at all-time highs. However, our local market is moving sideways on the back of the Banking Royal Commission. Give us your views on the markets at the moment, Burnsy.
Yeah, I suppose just the US is driving world markets at the moment. I mean, as you said, Marty, FOMC put up a interest rates quarter of a basis point, but also brought
Surprised no one, did it?
No, but what they did sort of say projecting going forward it'll be a little bit faster. So they brought another rise in this year, so for this year. Yeah. That's all on the back of very strong US economy, which is driving US earnings, which is driving the market. So it's a trade-off between earnings growth and interest rates. Obviously, interest rates going up is not good, but if earnings are going up by a faster rate, which they are at the moment, that's positive for global markets. But I said that the US is leading the charge here. Australia,
but the fact that rates are going up does mean that the economy is improving. So normally that should be a positive sign, right?
Yeah. As long as those earnings come through. Yeah. And that is what's happening at the moment. So we're having strong US earnings, much stronger than Australia.
And for Fed watchers, one of the other interesting things that came out last night was that the narratives changed somewhat, but a bit more hawkish in their view, and but are sort of focusing more on actually seeing the global economy improving. The language sort of shifted from sort of gradual hikes to sort of more consistent hikes. So yeah. I think that's a sign that global growth is going in the right direction. Yeah.
Yeah. I suppose the concern is just how far that has to go. We are sort of entering the mature stage of the economy, the economic cycle, but that could go on for quite a while. I mean, there's no inflation is still relatively benign.
Yeah.
Capacity utilization states is still looks okay, so they're the canary in the coal mine. And at this stage they look okay.
Now, one thing that it's not too far away, so it'd be good to sort of get your views as to whether you're hearing or seeing anything at the moment that investors should know, but reporting season, what are your expectations for that?
Yeah, well, we've been through this is sort of like the confession season, and it hasn't been too bad at the moment. So we're expecting that companies coming out reiterating guidance. That's always a good sign that things are under control. The Australian economy is chugging along positively. I mean, not great, but it is positive, and that we haven't had a lot of companies come out beforehand. They should all most should hit their numbers. So that should be a relatively positive reporting season then.
And where are we expecting the growth, Burns? Is it still be in the mining space, or can we see the industrial stocks performing better?
Yeah, I think that will be interesting. I mean, people sort of there's a lot of focus on the housing market at the moment. It's probably too early this result season to see where housing goes, but people will be looking at the outlook statements of all the companies as always, and just trying to see whether people are the companies are seeing any slowing from housing at this stage. It's probably a bit early for that, but they'll be very sensitive to see any weakening in demand in housing and housing related sectors. Outside of that, you've got mining still doing quite well, and infrastructure, a lot of spending on infrastructure by governments in Australia. So there's positive areas going forward.
Yeah. Now, Burnsy, before we go to some viewer questions or investor questions, I should say, that are starting to come through now, give us an update on the portfolio at present, how you're investing it and why.
Yeah, I suppose we've been running this strategy now for 5 years, over 5 years, coming up 6 years. The last 6 months, I have to say, have been the most difficult in terms of running the portfolio. And why is that the case? I mean, it hasn't been because of dividends from the companies. I mean, all the companies that we are investing in, the rate of dividend growth has not varied greatly over almost over the whole time. That's been low single digit positive. How the market is pricing those stocks, with what's happening with interest rates and also the whole swathe of regulatory investigations and commissions and changes, has put a bit of uncertainty, especially on the type of stocks that we like to invest in. So it starts to make us, I think you've got to be a bit more opportunistic. You have to be careful, give yourself a bit more of a buffer, and there's certainly a lot more volatility in the stocks that we look at, which are usually very low volatility, but they have increased over the last 6 months. So it's a case of making sure you're in the right ones and being prepared to take advantage of those opportunities as they come up.
And what is the biggest driver of the volatility in the stocks that we like at the moment, Burns? Is it the Royal Commission, or is it other?
Yeah, I think
factors?
sort of. Yeah, I mean, even though interest rates in Australia aren't probably going to go up till a year away at the earliest at this stage, the US increasing interest rates, what it does do, it's competition for yield funds. I mean, people are saying how far those interest rates go up. If interest rates are going up, then that's I'll wait to see how far they go up. It puts probably takes buyers away from the stocks that we're buying in, which adds volatility. So that whole interest rate regime going up is a little bit of a challenge. So it is going up very slowly and very steadily. So
investors look to switch asset classes. Is that what we're sort of saying there, or?
I think that they probably stops their buying or slows their buying. So where we've over the last few years we've had like adverse news will be met with not much of a negative reaction. Now any type of adverse news is met with a bad reaction. So what the stocks we hold, we pick them specifically to come out the other end of that. So, but you got to wear it meantime. And also there's a whole range of, adding uncertainty is the whole range of, the Royal Commission, but also policy changes and regulations of the whole range of domestic industries. So that just adds uncertainty, and people will step back and wait to see what happens.
Now, Burns, we've got a few questions from investor Michael Whelan. Thanks for your questions, Michael. So we'll kick them off. There are 3 questions he'd like you to answer. So the first one is, in what sectors do you see the best opportunities for CIE given its stated objectives?
Yeah, I mean, with CIE, it's a continual challenge to find high gross yields, but with a sensible risk spectrum. So the risk reward is something we always ask, always look at. Some of the sectors now, which with interest rates going up, traditionally they find it hard to grow. So that's like the property trusts, the REITs. Infrastructure, utilities, they're the most interest rate sensitive. So, we're cautious at them. I mean, we again, this isn't in like having their distributions change, it's how the market prices those distributions. We do hold them, but we don't hold a lot of them. But, we are cognizant that at some point they will become quite attractive. So, and if any opportunities pop up there, we'll be looking at them.
In the rates?
In all the interest rate sensitive ones. I mean, interest rates in states have gone from 1.5, 1.6 to 3. If they go to 4, then that'll be bad for the REITs. But the expectation is long rates in the states will peak out somewhere between 3 and 4, and that'll be an opportunity.
So just give the investors, Burns, I'll follow on from Michael's question. So we talk about interest rate sensitive sectors. You've mentioned REITs. What else?
Yeah, I think that then there's a huge opportunity in the Royal Commission impacted stocks. I mean, how we view that.
Banking,
I mean, there's the whole range of financials. I mean, we're reasonably big holders in them. They've got good balance sheets. They throw off a high frank yield, and their stock prices are quite low to very low at the moment. How we're handling that is we need a bit of we need to clear up the uncertainty around the Royal Commission. There's been a lot of newspaper press come out. What actually happens is what we're interested in, and how they sort of what policies actually brought in, what environment, what landscape do these companies have to operate in going forward. And you could see you could see probably our base scenario is that will be, it'll be okay for these things, and these are opportunity, but we need a bit more clarity on that before we move in there. And then also there's the other, the other non-impacted stocks, which we so those are marine industries that are high, stable, high franking. If we find anything like that, we'll buy them.
Okay. What are the greatest challenges to the portfolio at the moment, Burnsy? This is another question from Michael.
Yeah, I think it's finding out what happens with that Royal Commission and the other various regulatory issues. I think I count up about 40% of the portfolio has some type of government commission or regulation or policy change impacting it at the moment, which is high. That should come down, I would have thought. And that throws up opportunities. So it's trying to time those and find out if any of those changes are permanent reductions in value and how big that is for each company. As I said, the volatility is been quite high. I mean, one of our stocks is a patent lawyer. Was to give you an example of the type of volatility we're seeing that, and basically has no debt, a very stable income stream, and throws off a consistent dividend. Hasn't been listed that long, so it hasn't got a long history that we can look at. So that's a little bit of uncertainty, but came out with a disappointing interim result, and share price fell from over $5 to, I think it bottomed at around $3.20 or something like that. Now it's back up to $4.50, so above what we paid for it. So I think that's, but handling that volatility is a challenge. To not to sell out at the bottom is always a challenge. In terms of what, we've got a record of not buying stocks which have blown up. We've missed Slater and Gordon, missed Dick Smith, missed Retail Food Group, etc. To Vocus, a whole heap of stocks which have and the reason for that is that we concentrate on those companies where we have strong balance sheets and cash flow. So even when things go wrong, they have a chance to recover. So that's basically the basic theme. I mean, it doesn't mean you'll avoid share price volatility. We won't do that, but we don't want permanent destruction of capital. So that's the challenges, and we're looking to see housing, how bad that housing downturn is, the second order impacts of that. As I said, these regulations and where they really end up, and also the interest rate cycle. So there's a bit going on at the moment.
Absolutely. And so, Burnsy, so the third part of this question from Michael is, outside of the top 10 holdings, what are the next largest holdings, and how has this varied during calendar 2018, if at all?
Yeah, I'll answer that in one way. I wouldn't like to give the next top 10 holdings because that's will be half our portfolio, but what I would say is, if you want to have a look at the last ASX releases, the monthly releases, you will see stocks coming in and out of that top 10. And ordinarily, what we do is we sell stocks after we think we sell down after they've rallied and their yield isn't as high, so they may drop out of the top 10, but then they settle in the middle of the portfolio until there's opportunity, and then they may come back up again if the share price drops far enough. So you can probably put together a list of stocks which are still sitting there. I mean, outside of the top 10, I think that I think the top 10 is around 2.2% is the number 10. If you go to number 20, it's about 1.6. And number 30 about 1.3, 1.4% of the portfolio. So very flat. And there's a whole heap of stocks there that we do move around with the view to add when we think that they may have just had a poor share price for a while. If we can identify that reason, that's always good. And if we can do that and we're confident, we'll add a bit to it and then add some more so it moves back up. When the stocks do really well, the yield falls down, we take profits. So you'll see a slow rotation of and you know, every now and then the stock will go too far and we'll sell it completely, or they'll make an acquisition that we don't like or put on too much debt, so raise its risk profile, and that may mean that we get out completely, or we find something new and that comes in. Though, you know, those, you know, we're very careful to bring in stocks, so we want to do, you know, good due diligence on it before we bring in a new stock. So that hopefully that gives you an idea of how it operates and what may be in that next group of stocks.
Okay, thanks, Burnsy. Some great questions there from Michael. Thanks for sending that through. We've got a question from Paul Pecolano. Thanks for your question, Paul. He wants to talk about the portfolio and the decision that was recently made to reduce the cash allocation, Shawn, from 15%. Talk us through why we're doing this and how you're going to invest the money. Thanks, Paul.
Yeah, no, thanks a lot for that, Paul. That's a pretty important question. I think that what we found is, like, having the cash there, there is a couple of you know, when you run with a cash position, it makes, and run the type of portfolio we run, which is a yield portfolio, it makes you, you know, that's basically the cash rates aren't high, so you have to carry that reduction in income. So by and I think that, you know, even though it adds stability and adds optionality to the fund, especially in the early days, I think now, you know, we are moving that down from, you know, we've held 15% cash for most of the life of the company. That will go down to 5%. And what that does is increases our franking, our ability to frank the dividend will go up. And also the cash backing of that dividend goes up as well. So there's an extra 10% of the portfolio will be producing dividends, which we will pay out, you know, which helps fund the dividend that we pay out. So hopefully franking goes up, hopefully cash coverage of the dividend goes up. How are we doing that? We are moving that slowly and opportunistically in. You know, there's no real time frame to put it in very quickly. We want to be cautious on that. I think we're around 10% or so at the moment, and we'll slowly move that in over time. And also it means that, you know, people, instead of, you know, us making a big decision or having a big cash holding, people can hold cash themselves. You know, that's, at the end of the day, that's probably what you decide, that, you know, people can make their own cash decision, and then and we'll invest in yield stocks for them.
We are open for questions now, so all investors feel free to ask a question. I've got a couple coming through. I've got one before we answer that though, Burnsy. What's the company in the portfolio that excites you the most at the moment, mate? And I know you don't get very excited very easily, but give us your best one right now.
Well, I think, that is right. I don't get excited too much. I mean, we are sort of looking, you know, I probably can't say them. What we are looking at some new names. I think that, you know, and some of those I think are good stories. We've got target prices in mind for probably 3 or 4 stocks. It probably goes back to how we want to allocate that cash. There's a few stocks we've identified that we'd like to invest in. We are waiting for us to hit those prices. Now, in terms of when I look through the portfolio, which stocks I think have done well for us, you know, I think like that turnaround in GUD was very good. When any company refocuses its business on high ROE business away from low ROE businesses, has been usually a low risk way to add value. Charter Hall has been very, you know, that's a property fund manager. I think that you know, they've shown ability to raise funds, which is pretty important, and also been you know, reasonably good in the property selection side. So that looks like it's a continual growth story, which is good for us. And I think finally, I think Tabcorp hopefully is coming out of, you know, it's one stock. There's a few stocks that are going into regulatory malaise, I think, at the moment, or in a regulatory malaise. That one looks like it's coming out. So hopefully we're thinking of good things for that one over the next year or so. You can see point of consumption taxes being introduced across Australia. That's on their competitors. So that's sort of, we're hoping that is good news for Tabcorp, and they can perform a bit better.
So that would be on the online gamblers.
Yeah, the corporate bookmakers. Yeah. So yeah, so they haven't had to pay the same taxes as Tabcorp has, and this sort of evens it up a bit.
Yeah, okay. We've got a question from David Tomlinson. Dave's asked, which stock in the portfolio has been the strongest performer throughout the past month, Shawn?
Oh, the past month. That's a good question. I think it might be ASX actually. I think
Okay.
I'd have to have a look, and yeah, I'd say, but that's just off the top of my head. I usually don't sort of like keep the monthly numbers of all the stocks but I think we've also seen a couple of good bounces. Like when I spoke about IPH before, some stocks that have been, we thought have been wrongfully sold down, just been really harshly dealt with in the market. And then it becomes, you make assessment, what's the market think of those? If we like them, we've added to them at lower levels. Some of those have bounced back pretty strongly. So, cheap Super Retail and IPH, the patent lawyer, both been strong performers as they've bounced off oversold levels. So we've seen a bit of that. It's up to us to work out whether those there's real problems with those companies, or whether we want to add some at cheaper levels, which we've done.
Question from Charlie Smith, Shawn. With the market pulling back, are you seeing an increase in solid yield opportunities? What sectors are giving the best yields at the moment?
Yeah, well,
we're watching that closely, right?
Yeah, no, it's no, that's right. I suppose you don't have to look too far. You can see where the big opportunities are, and they're stocks that are impacted by the Royal Commission. Those yields are now huge. It's the uncertainty. Obviously, the uncertainty that we want to see clarity on is what the actual Royal Commission comes out with, and as soon as the market starts to get a sense of that, and if it isn't too bad, if it's and that's a matter of degree, then that all those stocks have been sold down quite heavily. The fund managers have all been sold down quite heavily. The wealth managers, etc. The banks, the small banks, they've all been sold down. So there's the opportunity, and it's assessment of when the risk reduces enough to make those returns attractive.
Okay. Well, look, that's all. We're getting close to our finish time. We don't have any more questions at this stage, but we have had some excellent questions from our investors, so we thank you for that. We also thank you very much for the support that you give to us and the trust that you put in us to look after your investment. It means a lot to us, and we're very grateful and very appreciative that you've given us this duty to help you with your financial affairs from an investment perspective. If you are a new or prospective investor on the call today, and you haven't invested in CIE, it's a fantastic product. It's been going for as Shawn said, 5 years now.
Oh, that's the strategy's been going for 5 years, and the fund for 3.
For 3. The income is incredibly solid. As high as it can get amongst its peers of 6.5% per annum. It's a stock that you can or investment you can buy through the ASX. The code is CIE. So we appreciate your time and your support. We'll also be making this webinar or investor call, I should say, available through our website. We'll be emailing it around in the coming days. You can also subscribe to our investor newsletter that we send out twice monthly updates exclusively for CIE investors or parties that are interested in CIE. And once again, thanks for your time, and we look forward to talking with you again very soon. I'm Marty Switzer. With me is Shawn Burns. Have a great morning.
Thank you.